today and tomorrow are sessions 23 and 24 of this course, Career Builders. And so we're going to take a break. Now, I was going back and looking at some of the recordings, and I screwed up a little bit a few weeks ago. I think Lisa had said, gee, Hal seemed to feel like we were coming to an end earlier than we were going to. And that's because I was still on page one of the schedule. And if I was smart and turned it over, I would have seen that there were several more weeks. But we are going to take a break after tomorrow, right? I'm going to do a session today on agent financials. And then tomorrow, Patty's going to do a session on sort of risk management, right? The stay out of jail class, which I highly recommend. I don't think jail is a good place for anybody. So once that's going to take a little bit of a break, and then what will happen is starting on Monday night, June 7th, so about 3 weeks. On Monday night, June 7th, we're going to start this cycle all over again. So if you've missed some of it and you want to come back and cycle back around, that's going to start again on the 7th of June, and we're just going to keep going. And this is a series that's going to run sort of in this ongoing pattern, probably 4 times a year, right? So just watch for that. If you want to cycle back in, take any part of that, you're welcome to go ahead and do so. But today we're going to talk about financials, agent financials. This is a course, a part of the course that if you've been in Ignite, some of the things that we're going to talk about today are in the new Ignite 2.0. It's a lot of the stuff that we never really taught in the very beginning of real estate, right? All the basics of how do you handle the money part of this? So here are just some tidbits that I want to start with. Sort of habits for a financially sound business. Number 1, set a profit goal that funds your big life and pursue the activities that's required to make that happen. One of the things that we are going to talk about a little bit today is how much gross commission income do I need to create so that after all the different expenses that are out there, after I'm done sharing money with the broker and Uncle Sam, by the way, today is tax day, right? After everybody is done taking their cut, that I still have enough left over to create the life that I want for myself and for the people that are counting on me. So number 1, habit, set a profit goal that's big enough to fund the life that you want. Number 2, estimate, save, and pay for taxes on time. We're going to talk about that today. Number 3, use proven models and systems, which we are going to also talk about today in terms of what are some of the financial models to be thinking about as you run a real estate business. And you can, if you want to, go online and get what we call a chart of accounts. You can go on to the Keller Williams website, go into Keller Williams University, just type in MREA chart of accounts, and you should probably come up with a ledger, which is just a big old spreadsheet. And on that spreadsheet, it has every possible expense category that you could ever have in your business. And that's something that you can use. Now, I personally use QuickBooks and have been a big fan of QuickBooks, but the chart of account exists online. You can go get a copy of that if you want. Habit number 4, be fiscally savvy, review your financials regularly. Number 5, pay yourself a salary. We're going to talk about that today. Paying yourself and how much should you pay yourself. And then 6, prepare now for a financially secure future. We're going to wind this session up today to think about not only how do we create wealth, but how do we protect it, right? Because that is something as well when you're running a business that a smart, savvy business owner not only thinks about how do we generate wealth, but how do I protect wealth as well. So those are the topics we're going to get into tonight. If you have other questions, feel free to unmute and ask as we go along. Again, if you can get on camera, that's great. If you can't, if it's dinner time, you got kids around at home, then I get that. Here's what Gary Keller says. Money is good for the good that it does. Money by itself isn't good. Money by itself isn't bad. And here's one of the things that I have learned as a coach and as a trainer in the real estate space for almost 2 decades now. One of the things that I found is, do you see my thermostat here slide, the slide that has my thermostat on it? One of the biggest challenges that I find as a coach is to help real estate agents turn up their thermostat when it comes to creating money in their lives. Now, we all have this, many of us have this fantasy, this idea that I want to have money, that I want to have wealth. And we all have this fantasy of what would I do if I hit the lottery and all that stuff, right? And yet, one of the things that I've come to learn is that there is a lot of baggage that a lot of us have about getting into a different financial status than we are currently, or that we've grown up in. I grew up in a family that didn't have a lot of money. And so I know I've lived this personally, is how do I kind of wrap my head around what money means? And we live in a society that fill in the blank, right? Money can't buy me what? What is that? What's the end of that statement? Money can't buy me
happiness.
Happiness, right? Now, I could learn to be unhappy in some really nice places if I had money. That's just me. However, George Harrison once said, money can't buy me love, right? Money is the root of what?
All evil.
Right. So there's all this stuff, right, that we've learned about money. And one of the things that I'm just going to put out there on the table right now is, as you're getting into real estate and you're starting to think about creating a business, money isn't good. Money isn't bad. Money is simply energy. And it allows for things to happen in your world. We do live in a world where we need to have money to make things happen. And here's what I've learned. Money is, you know what money does? Money reveals who you are. If you're a good and kind and generous person and you come into money, you're only going to become a kinder and more generous person. If you're a jerk and a stingy whatever, and you come into money, it's just going to be more of the same. Money tends to reveal who we are. And I think about a thermostat, because there's a difference between a thermostat and a thermometer. What a thermometer does is it tells us the current temperature. What a thermostat does is we have a goal of what the temperature we want it to be. And the thermostat does what? It adjusts our environment. It turns up the heat when it's too cold. It turns on the air conditioning when it's too hot. It makes adjustments in our world so that we can get the temperature to what we want to be. What we need to do, and what we're, one of the things that I work on a lot as a coach is help people figure out what is the dial-in setting for your income and how are we going to adjust our activities to make that become real. So turn up your thermostat. Here's a saying that I love. If people aren't laughing at your dreams aren't big enough yet. If people aren't laughing at you, and we think about that. Nobody likes to be made fun of. Nobody likes to be the butt of jokes. And yet, what I know is this: having been around entrepreneurs and studied entrepreneurship, one of the things that entrepreneurs find is that people have a habit of kind of ridiculing our dreams. Right? Because we have this thing about not growing out of the area of financial stability where we were, not getting into a different financial class. And so people laugh at our dreams. People sort of tell us why it can't happen. I saw a Facebook meme over the weekend with one of the agents in our market centers. And I honestly, for the life of me, don't remember who it was. So if it was one of you, you can claim it. But it was a woman who said that she went onto Facebook and found her meme, and the meme simply said something along the lines of, they told me I couldn't, so I did. Right? I think a lot of times that's what I hear people getting into real estate sort of saying is, look, I have a dream of what I want for my life and for my family and for my kids. And it takes money to make that happen. And I have a big dream for everybody, and I don't want to let people down. And so I'm going to make it happen. If people aren't laughing at your dreams, you're probably not dreaming big enough yet. Let's talk about the models, right? There are a couple of different models that we teach in the Millionaire Real Estate Agent book, the MRE book. And one of the models is what we call the economic model. There's 4 different models. Anybody, an MREA aficionado, can tell me what the different models of the MREA are and what they're about? Well, the economic model is model number 1. And what do you think the economic model talks about? Someone unmute and have a conversation with me. What do you think the economic model is all about?
Just making sure that I'm guessing here. Just making sure that your expenses aren't outweighing your profits.
It's all part of it, Dan. What the economic model is, it's the numbers of our business. It gives us a sense of what should we be aiming at, right? It's kind of how do we keep score, right? And the economic model basically gives us some ideas in terms of what we should be shooting for. Once we know what those numbers are going to be, then the lead generation model teaches us what behaviors do we need to instill to kind of make those numbers show up in our business. The budget model helps us to make sure that we're profitable, because there's a difference between creating money and being profitable. We do understand that, right? If your expenses are out of control, then you can be making a boatload of money and not have anything to show for it. So the budget model helps us to make sure that we keep our expenses in line. And finally, the organizational model, which speaks to leverage. And how do we create the right leverage in our business? But here's what the economic model tells us at the 40,000 foot view. If we have 100% of our income coming in, it goes into three main buckets. The first bucket, 30% of your revenue, goes into what we call cost of sale. That's an expense bucket. And your cost of sale in the real estate terms has to do with what does it cost for you to be in relationship with your brokerage, right? That's the way we think about it in real estate, because in real estate, unless you're the broker owner yourself, you can't operate unless you operate under another broker. And it costs you something to be into that relationship. And that is 30% in our world. So in a different industry, in manufacturing, for example, cost of sale would include things like how much does it cost to source all the materials to make the widgets that we're making and all that stuff. In real estate, 30% of your revenue, your gross commission revenue, should be allocated to your relationship with your broker. The other 30% should be allocated to your operational overhead. And I'm going to talk to you about in a little bit that if you're working as a solo agent, you can run a much leaner ship than you can if you're running a bigger business enterprise. But 30% goes to the cost of sale, 30% goes to operation, and then 40% is what you have as profit before tax. And that's the MRE model that would suggest that if you have a $10,000 commission check, $3,000 goes to the broker, $3,000 is allocated to run your business, and $4,000 is what you get to keep before taxes. Now, how does that feel? Does that feel good enough? Does it feel like it's too small? What's your sense around that?
Yeah, it's always too small, isn't it?
Always too small. It feels too small, isn't it? You know, here's the thing that I'll tell you. Has anybody ever owned a business before, the real estate business? Has anybody ever been a franchisor in another business or anything like that? Here's the thing that I'm going to tell you. Because I've owned several different businesses. Some of them have been really successful, and I've owned some businesses that have completely crashed and burned. So I can tell you from personal experience that if you were to keep 40 cents on every single dollar, that profit margin is astronomical in the business world. Most businesses, if you think about a restaurant, if you think about a McDonald's, let's go to McDonald's for a second. If you go to McDonald's and owned a McDonald's restaurant, for every dollar that you sold, if you could keep 5 or 6, maybe 7 cents of that to hit your profit line, you would be thrilled. 93, 94, 95 cents of every dollar in a McDonald's franchise is going to other people. And you look at that and say, well, how the hell can you be profitable? Then how can you run a business if you're only keeping 5 or 6 cents on every dollar? Well, the difference is in the unit volume. McDonald's sells a lot of stuff. You can go to the parking lot to a sign that says billions and billions of people have eaten here. And when you're only keeping 5 or 6 cents on a dollar times billions, that turns into real money real fast. For us, we keep about 40 cents. That's the model. That's the target, 40 cents on every dollar. The question is, are we doing enough units for that to turn into enough money to fund the life that we want? But the model would suggest that if your business is running well, expect to keep about 40 cents on the dollar. That's what the model would tell us. Now, let's talk about sound or unsound models. There's 2 different scenarios here that I'm going to describe to you. And this is going to be Jessica Campbell is the agent. And on the left-hand side, here's what happens. She has a sale. She has a closing. Right? She comes back, she brings the check into her market center, she rings the bell, they take a picture. You guys are all seeing all the pictures on Facebook with people ringing the bells with their checks in hand. And she gets a $9,000 commission check. What Jessica does on the left is she turns it into the market center. They take their cut, their split, and they give her in turn a check for $5,760, which is 70% of the commission. What Jessica then does is she goes to the bank, she puts that in her personal bank account, and what she then does is kind of spends it because it's in her bank account. It's kind of in her wallet. She's not put any money aside for her operational expenses. She's not put any money aside for her taxes. And then you look at model number 2. Jessica gets commission check of $9,000. She gives it to the market center. They take their cut. She gets $5,760. And what she does is she goes to the bank where she has a business bank account, not her personal account. Now she's running a business, so she has a business bank account. And in that business bank account, she puts that check. $1,728 is what she leaves for operations. $4,032 is then what she puts into her personal account, of which she allocates 40% of that for taxes, and the remainder, the $2,419, is what she has to spend. Now, this is not an IQ test, but it's a pretty self-explanatory question. Which of these models is a more sound way to run a business? The one on the left or the one on the right?
Right.
Right.
One on the right, right? And there's a couple of big differences here. Number one, do you notice that on the right-hand model, Jessica is not running her business out of her family's personal bank accounts? She has separate accounts. We need to do that as well when we're running a real estate business, right? One of the things that happened during COVID, guys, was there was a lot of advocacy on behalf of the National Association of Realtors. For the first time in history that I can think of, independent contractors and realtors were able to collect unemployment. And for those that were also running businesses that suddenly had their business come to a screeching halt in the early days of the pandemic, they also qualified for payroll protection loans. Now, guys, that is unheard of in our industry. Real estate agents as independent contractors, when bad things happen, you kind of take on that risk. That's always the way that it's been, but it was different this time around, and largely because of the advocacy work on behalf of your National Association of Realtors. So remember that the next time they ask you for a contribution for the RPAC, the Realtor PAC. But here's the thing. Lots of agents said, okay, I'm going to survive. And what happened is the administration of those payroll protection loans was done at the local bank level. And so people were directed, go back to your bank. They're going to administer this loan, this payroll protection loan, at your local bank. So lots of realtors that I know went to their bank and said, hey, I want to apply for this PPP loan. And they said, you don't have an account here. And they said, wait, yes, I do. I've got an account here. I've had it for years. And they pull out their checkbook and they show them that the account is there. And they say, oh, I'm sorry, that's a personal account. In order to qualify for a business protection loan, you have to have a business account. You do not qualify by having a personal account. So we've got to make sure that we've got the right kinds of bank accounts. Guys, when we're running businesses, we need business accounts. And when we're not running businesses, we can then have personal accounts. And I'm going to tell you that as you go out and shop different lenders and banks for the kinds of accounts, business accounts are places where banks try to make money. They look at businesses and say, okay, businesses are making money, hopefully. And so we're going to have a lot of fees in these business accounts, far more fees than we would sometimes see in personal accounts. But what I've come to learn is that banks can be negotiable. The big names like Wells and Bank of America, probably less negotiable because they're the big bureaucracies and they don't think they have to. But the smaller independent banks, the local banks, the ones that maybe only have 4 or 5 branch offices in your county, those banks can oftentimes have business accounts with little or no fees. Or credit unions can be great sources. But make sure that you've got a business bank account for your business. In fact, I'm going to tell you in a couple minutes, that you should probably have more than one account. You should have one account, which is your operating account, where you put your money to spend your business, that you pay your credit cards out of, your business credit cards, that you write checks out of. And I'm going to tell you, you should probably have a different account where you put the money that you're putting aside for taxes. And maybe even a different account where you pay yourself a salary, which we're going to talk about tonight. But at minimum, get a business bank account. All right. Any thoughts, questions around that before we keep moving? Okay. I talked about taxes. And one of the things that we have to do as responsible business owners is we have to pay our taxes. Now, today happens to be tax day. Would have been the 15th of April, but we got a reprieve, right? We got to kick that can down the road a little bit, and now taxes have to be filed by midnight tonight. But let me ask you this question. As an independent contractor, when are your taxes due? Do you know the answer to that?
Before the end of the year, I believe.
Before the end of the year. Okay.
October?
October. Anybody else? Well, here's the trick. It's no different when you're an independent contractor or you're not an independent contractor. According to the IRS, taxes are due the moment income is earned. The moment you get paid, those taxes are due. Now, there's some logistical problems with that for us because we get paid lots of different times a year at all different intervals. And what the IRS says is, look, we don't have the bandwidth or the manpower to process a tax payment every single time you get a commission check. That's just way too complicated. So what we're going to allow you to do is estimate how much earnings you're getting at each quarter and make an estimated payment per quarter. And then once a year on the 15th of April, we're going to review the whole thing and take a look and see how close your estimates were to being accurate, right? So the thing that we have to remember is the taxes are actually due the moment that they're earned. And so it would be wise for us to not spend that money. When we get a commission check, what I truly believe is best practice is figure out how much you're going to allocate towards taxes and get it out of your field of vision. Just get it out of your account. Because if you don't, you're likely to spend it. And then when Uncle Sam wants it, it's not going to be there. And I have seen through the years really, really strong, good agents who are very capable of making money happen. And this isn't just true in real estate. This is true in lots of businesses. I've seen lots of entrepreneurs who are really good at creating money. And because they can do it efficiently, they don't always put the money aside for the tax man. And then they just have this belief that I'll just be able to naturally put business together and make that money show up when I need it. You can't always count on that. I know lots and lots of real estate agents who are in a bad spot with Uncle Sam. And what I would recommend that you do is just figure out how much money you're putting aside for taxes, put it into a different bank account so it's out of your operations account, and just let it sit there and so that it's ready when you need it, right? Now, the dates, just so that you should know. Estimated taxes for 2021. Here's what the IRS says. The estimated payment for the first quarter, January 1st through March 31st, that payment was due on paper on April 15th, and that's the one that got extended until today. So if you had first quarter earnings and you haven't made an estimated payment, you can still do it up until midnight tonight. You got 5.5 hours. The next quarter, second quarter, is due on June 15th. Third quarter is due September 15th. And the fourth quarter payment is actually due on the 15th of January in 2022. So I would just circle those dates on my calendar and plan ahead to start to figure out how much should I be estimating to send and what day should I be sending it. And you can register with the IRS and you can do it electronically. You can write them a check. There's lots of different ways to do it. But put those dates on your calendar would be something that I would recommend that you do. Now, the $64,000 question is, how much should you put aside? And that's, there's a lot of things that I'm not going to be able to give you advice on tonight. I don't know how much you should hold back for taxes. I can give you what we recommend as a conversation starter and then direct you back to your tax person, whoever does your taxes, to help think about what should be the amount for you. But what we recommend at Keller Williams is that you should put 40% of your income aside for taxes. 40%. And a lot of people say that's way too big a number. And for you, it might be. If your tax person says that's too big a number, then listen to them and adjust accordingly. But here's what we have to account for. We have to pay our state taxes and our federal taxes the same as everyone else. But we get another tax in the industry because we're independent contractors. We have to pay what's called a self-employment tax. Self-employment taxes cover your Medicare when you get to 65. Self-employment taxes cover your Social Security and retirement when you get to retirement age. And typically those are payroll taxes that when you work in a company, they take those taxes out of your paycheck and send them to the IRS right away. So that's put aside for you. And the employer pays part of it when you work in a company. When you are the company, you got to pay the whole thing. And so what you should know is that the current rate of self-employment tax in the United States is 15.3% of your income. So when you add something for state taxes and something for federal taxes, whatever your tax professionals tell you should do, remember, you've got to put another 15.3 aside for self-employment taxes. So we recommend that you put 40% of your gross income aside, unless your tax professional tells you differently, right? Questions around that at all? Now, remember, go back to the Jessica Campbell example. She got a commission check of $9,000. She's not paying tax on all $9,000 because the broker's keeping some of that. She only has to pay income tax on what? The money that she was given. And if she's got business expenses, remember the model, 30% of your income goes to the broker. They took that off. 30% of your income is allocated to operational costs. And the beauty of running a business is that a lot of your operational costs become tax deductions. So you can deduct from your taxable income, right? But just know that those are the numbers. Okay. Now, we'll talk a little bit about business structure here for a second. Because when you're working as an independent contractor, most real estate agents, what they do is they file their real estate earning income along with their family's tax return. If you're married and filing jointly, married filing separately, or if you've got another source of income, does anybody have another source of income outside of the real estate earnings? Quick show of hands on that. If you do, right, you're going to file your taxes. And then what most real estate agents do is they file what's called a Schedule C on their personal tax return, which accounts for all of their real estate earnings. And there's their income and their deductions. All that stuff is handled on what we call a Schedule C, but we're filing as part of our personal taxes. And here's the thing that you have to understand is that because the tax code is the tax code, your personal tax level is the highest tax that you could pay. Businesses get tax breaks. And part of the reason why the IRS and the government gives incentives in taxes to businesses is so that businesses can create jobs. And there's lots of reasons why they do it. And I'm not going to get into the politics of whether they should or they shouldn't. Should we have too much or too little? It's just understand that your personal tax rate is the highest amount of tax you could pay. If you incorporated your business into a business structure, you're likely to pay less taxes. And maybe that makes sense for you, and maybe it doesn't. I'm not going to recommend what you should do, but what I would suggest is you have that conversation with your tax people and your attorney and see, does it make sense for you to run your business as a incorporation? And lots of different options there. LLCs is probably the most common one, which is a limited liability corporation. Sometimes people file as S corps, or sometimes they create partnerships. Again, I'm not going to get deep into the woods on all the different business entities out there. But what I would suggest is you have a conversation, because taxes paid through businesses are paid at a much lower level, which means more money for you, right? I personally, I'm just going to tell you my own bias. I have incorporated most of the businesses that I run. And right now I have a coaching and consulting company. In fact, I train for Keller Williams and bill them through my coaching company and training company, which is licensed as a LLC. And I personally like the idea of running my business through a limited liability company, because what it does, guys, is it creates a bit of a firewall between your business and your family's assets. Think about this for a moment. You're running a real estate business, everything is good, and then something really bad happens. And I don't know what really bad happens, but you get sued. And the lawsuit is such that you're not necessarily covered under your errors and omissions insurance policy, right? We all have insurance, errors and omissions, which covers us if we make mistakes. But now let's just say that something bad happened and the E&O didn't cover it. And there's a big settlement, a multi-million-dollar settlement. What happens if you're running your business as a solopreneur, as you're just running as Hal's doing real estate as a solo person, unincorporated, then to pay off that lawsuit, people can come after your personal assets. They can come after your house. They can come after your car. They can come after your kid's college fund. All of those things can be seen as fair game to settle that debt. If you are running your business through a corporation, the only thing that they can sue is the corporation and the assets inside of the corporation. And it creates a firewall. If the business didn't have enough assets to cover that settlement, the business might go bankrupt, but they could only go after the assets of the business and not you, the individual. I personally like that idea, but you have to decide what's right for you, right? Doesn't cost a lot to set up an LLC if you want to do that. You don't have to pay lots and lots of legal fees. There are plenty of services that will file your business incorporation with the state. They will file with the Social Security Administration and the IRS to get a tax number. And all of that can be done for $500. Doesn't cost a fortune. But whether or not you choose to incorporate or you don't, have that conversation and decide what makes sense and decide whether you're going to do that or not. There can be some tax benefits. There can be some legal protections for you as well. Any questions around incorporations at all before we move on?
Yes. What if you already have an LLC? Can you combine the two?
That is beyond my knowledge, and I don't know. My suspicion is probably not, because when you're filing a business and your articles of incorporation have to specify what's the nature of the business, and if you're doing something different, you probably can't combine them.
Right.
Find out. I actually have owned up to 4 or 5 different LLCs at the same time doing different things, right?
Okay.
But it's a great question. Here's the other thing you're going to find out. The state of New Jersey does not allow your broker to pay the LLC a commission check. Commission can only be paid to individual agents. But Angie, if you were getting a commission check and you owned Angie's super cool real estate company LLC, because you're the owner of that company, that check, which is made out to you personally, since you're the principal owner, you can go ahead and deposit into the bank of the LLC without any problems, right? But think about that, right? Something that you may want to do.
Thank you.
I had a real quick question. if
Go
you don't
ahead,
mind.
Chris. I don't mind. That's what I'm here.
If you were to set up an LLC, how would that work as far as your, I guess, marketing and stuff? Because you're a Keller Williams agent, but then you set up an LLC for, Happy Time Real Estate or something like that. Like, how does
So if your business, Chris, if you created a business entity that you called Happy Time Real Estate and you wanted to market that, you could do that. You could market Happy Time Real Estate. Now, however, you're going to have to still do it as with all this co-branding that's going to have your broker and your broker's address and your broker's phone number and all that stuff. But there's lots of folks who do that, right?
I thought that was illegal. Okay.
No, it's not. If you are creating, and we see it more commonly in teams, right? And so you'll sometimes see that the team will market the team. There's plenty of teams that you can go and see their team name on the side, but it also has to include both the broker. You can't do it to the exclusion of your broker. That would be illegal.
Right. Okay.
Right. What the real estate commission wants to make sure of is that the consumer always can figure out who your broker is and find a way to reach them if they had a question. But yeah, you could do that, Chris. You could market your own business as an LLC.
So if you market both of them, if you have a listing, then that would be okay. Whereas, you couldn't leave out the Keller Williams.
Yeah, you can't leave out the Keller
right.
Williams.
Okay, I got you. Thank you.
Yep. All right. So lots of different business models out there, business structures. I'm going to tell you, I would think probably only 20% of the agents do file articles of incorporation for their business. It's not to say you should or you shouldn't, but most agents tend to just kind of do real estate, even if it's their primary income or one of their main sources of income. Most of them, from an accounting standpoint, tend to treat it more like a side hustle and just kind of throw that money into their personal bank account and don't really think about creating kinds of special firewalls, right? Okay, moving on. One of the things that we said was a best habit is to get that check into your operations account and then pay yourself a salary. That is really best practice. Now, how much should you pay yourself is an open question. Because when you're starting a business, and there's plenty of startups that will tell you that in the beginning, they tend to forego taking salary and put more of their money into their operations, into their marketing, into their business overhead, so that they can grow faster and gain momentum faster. And some folks will say that they'll defer salary until they've got more business coming in. But these are some models. This page here that I photocopied comes right out of the Millionaire Real Estate Agent book. And it starts to take a look at, depending on the revenue of the business that you're running, $0 per 150,000 of gross commission income a year. When you start to take a look at profit and owner's comp, what we're seeing is owner's compensation should be about 50%. About 50% is your owner's compensation. Why? Because when your business is smaller, you're doing more stuff yourself. Right. And so in order to pay yourself a reasonably good wage for all the work that you're doing, that compensation is about 50%. As your business grows, the percentage drops down. 35% when you're running a business between 250 and 500,000 a year, 20% at 500,000 to $1 million a year, 10% at 1 to 5 million, 5% 5 to 10 million, and 3% 10 million and higher. And again, now what are we looking at? We're looking at the McDonald's phenomenon. I'm only getting 3% of the dollar, but at $50 million a year, there's so much volume coming through that turns into real money. The thing that you always want to think about, and I stole this off of the internet here, the median CEO for a company running assets between 10 and $25 million in revenue a year is about 52%. That's about what you should pay yourself, what you're worth, and put that money aside as salary, right? That would be the recommendation. Don't just go into your operations account and take money out when you need to pay the bills. Give yourself a legitimate salary and a payroll expense that you can give to your accountant at the end of the year and say, this is what my payroll expense was for the year. And who did I pay? I paid myself. But you have then a legitimate expense category. Okay. Highly recommend that you do that. Okay, let's talk more about the MRE model. We said 30% of the revenue goes to the cost of sales, 30% to operations. You're likely to keep 40%, but it's different when you're a solopreneur, meaning you're doing it all by yourself. Why is it different? Here's why. I think you can run a lot leaner when you're running a solo business, especially where we run it, which is in a fairly expensive area. When you're running business and you don't have payroll to pay outside of yourself, the biggest expense category in most businesses, guys, is payroll. Would we agree? Most business owners will tell you that's their biggest expense. And when you're running a bigger team and you've got to hire a transaction coordinator and you've got to hire an administrative assistant and you've got to hire somebody to do your marketing for you, now you're taking on payroll expenses, which can add up to be a big chunk of money. And if you look in the MREA, the Millionaire Real Estate Agent book, what it actually says is about 12% of the operational costs. So we're putting 30% aside for operations. About 12% of that should be allocated to payroll. If you don't have anybody to pay other than yourself, then you get to keep that, right? You're paying yourself. But we also do business in a very expensive price point area. The median price in our marketplace is very high. And why does that mean it's less expensive for us to run our business? Here's why. We don't have to sell as many houses to make the same amount of money that somebody would have to sell if they were working in a less expensive area. Does that make sense? Do you know what the median price is in Bergen County in your marketplace? What do you think a median sale price would be in Bergen County today?
700.
700, 750.
It's not that high, actually. It's closer to 525. Now, may not be in the town where you live, but when you start to add in the Hackensacks and the Pagodas and a lot of other towns where the price point is more modest, the average in Bergen County, really the median, the midpoint, is probably in the low fives today. The midpoint in the state is probably about 3.25, 340. The midpoint in the country is probably below 300 today. And so here's the difference. When you're selling houses at $700,000 a shot, you don't have to sell as many of them as you would have to sell if you were in Western Texas, where the median price is $180,000. And here's why that matters, because inside of your expense categories, guys, we have what's called a fixed expense, and we also have what's called a variable expense. Who can unmute and give me an example of what a fixed expense would be? It doesn't change regardless of how much volume of business you do. What would be an example of a fixed expense?
Like what you pay for the super key.
Okay, that's a fixed expense. It's $14.99 a month or whatever it is. Your board dues, Laura, are going to be fixed. You're going to be $600 a year, whatever it is, whether you sell a house or a million houses, it's the same $600. Now, give me an example of a variable expense. The more business you do, the more expense you take on. Marketing. The more listings I have, the more marketing I have to do, the more expensive that becomes. The more listings I have, the more signs I have to own, the more lock boxes I have to own. And so one of the things that happens is because of our price point, and we don't need to do as many units to get to the same gross commission dollar, we naturally have fewer variable expenses, which means it's cheaper for you in this part of the country to run your business than it would be if you were running somewhere else. And that's a good thing. What you should know is that the net profit difference is about 15% in my experience. What I've seen is it's about 15% more. So 100% comes in, 30% goes to the broker. Instead of having 30% for your overhead of your business, you could really do it for about 15%. You can run that much leaner, and the difference goes right to your profit line, right? Any questions around that? I know I'm throwing numbers at you right at supper time, and that's not fair, but that's what happens when I do the topic on finances. Got to throw some numbers at you. Any questions around those numbers, how we came up with them? If not, I want to talk to you about the flow of money. Here's what we've learned and we've been taught in business. Income, what comes in, minus expenses, what goes out, leaves us profit. That's what we call the flow of money. Income minus expenses equals profit. And I don't love that model for a couple of reasons, which I'll get to in a moment. But here's another way that we teach you to think about it. Let's put profit up on the top for a second. What I need to think about is how much profit does it take for me to create the life that I want for myself and for my family? Because at the end of the day, the money that I have to spend to create the life that I want is only spendable if it's profit. I can't spend money that I have to put into the taxes. I can't spend money that I have to give the broker. I can't spend money that I have to put into my business. The only money that I have left that I can spend is profit. So we start with how much profit does it take to fund the life that I want? And then we jump down to figure out how much gross income needs to come into the business so that after I deduct my expenses, I have what I need. That's the way I really want you to think about the flow of money. Income minus expenses equals profit. However, profit, when we know what that is, then we can figure out how much income we need to generate, so that when we deduct the predictable expenses of our business, we have what we need to make that work. And I'm going to give you an even better model. There's a guy by the name of Michael Michalowicz, and don't ask me to spell it, but it's Michaelowicz is his last name. Mike is a business, kind of a guru in the business world, author of many, many books. He's a Jersey guy, comes from North Caldwell, I believe. And one of the books that he wrote is called Profit First. And I've taught a lot on Profit First through the years. Here's what Mike teaches us about profit. When we think about this model, income minus expenses equals profit. The problem with that model is we think about profit as an afterthought. It's what's left over. If we have enough income and don't have too many expenses, we don't really know whether we're profitable or not until the math is all done at the end of the year. And what Mike says is that's no way to run a business. If you really want to make sure that your business is profitable, the equation should be this: income minus the desired amount of profit leaves you your expenses. Instead of income minus expenses leaves you profit, where profit is maybe it'll happen, maybe it won't. He encourages that you build the profit in. You take your income and then take the profit out first. Pay yourself first and put that money aside. And then what happens is whatever you have left over is how much you have to run your business on. Has anybody on this call, other than me, ever had to learn how to live within a budget? Okay, we all do, right? And if the budget is smaller that month, I'm going to have to figure it out, aren't I? And when you do it this way, there's this time management law called Parkinson's law. Maybe you've heard of it. Here's what Parkinson's law says as it relates to time management. Work has a way of expanding into the amount of time that's allowed for its completion. Work has a way of expanding into using up all of the time that we've put aside to complete the task. If I have to clean my garage and I give myself 3 days to clean the garage, how long is it going to take me? 3 days. If I give myself 1 day, how long is it going to take me? 1 day. It's amazing how efficient we can get under the pressure of time. Just think about your last day before you go on vacation and how much you get done. That's Parkinson's law. Now, what Michalowicz does is he applies that to finance and says, what if we decided to take the profit out of the business first and then learn how to live around the edges of whatever I have left over? Then what we're going to make sure of is that at the end of the year, we've always got that profit. It's always going to be a profitable business. Because what businesses do is they tend to spend to the level of money that's in their operations account. And if they've got a lot of money, they're going to spend a lot of money. If they've got a little bit of money, they're going to spend a little bit of money. But if you take the profit out first, and in fact, here's what Mike says to do. Remember I said have multiple bank accounts? Have an operations account, a business account to put your operational money in. Probably have a second account to transfer the money that you're going to pay the taxes with and get that out of your field of vision. What Mike says is have a third account that he calls a profit account, and put the profit into that account first. And you decide how much that is, whether it's 1%, 5%, 10%, whatever profit you desire. My recommendation for a startup business is start small, because you do need to put revenue into your operational costs, right? It costs money to build a business and get things going and get momentum happening. But start the habit of taking a certain amount out to guarantee the profit each check, each commission check, whether it's 1%, whatever it is, take it out just to get in the habit of being profitable. And what Mike says is put it into a different account and put that profit account in an entirely different financial institution. Put it in a different bank. Any ideas why he would suggest that you do that? That you take your profit out and put it into a different account in a different lending institution.
It just deters temptation, I would think.
That's it, man. Because if you're having a lean month, if commissions are slow and you suddenly have a big marketing thing that you want to do, and you look at your operations account and say, I don't have enough money, it's really tempting to transfer the money from your profit account right into your operations account and blow right through your profit. And to reduce that temptation, Mike says, put it in a different account. Just make it hard on yourself to do that. Because here's what happens. You'll learn to figure it out with the revenues that you have in your operations account. All right, profit first, really good model. A couple other things I want to get to in the time that we've got. The difference between income and expenses. Income is anything that's bringing money in, right? So we think about listing income, commission checks for listing, commission check for sales, commissions that we earn for leases, rentals, commissions that we earn on referrals, right? One of the highest dollar productive activities that you can do is find an opportunity and give it to somebody else to do all the legwork. And
I
then
have a
when that
question
deal
here.
closes, you get paid a referral fee. Go ahead, Angie.
Yeah, on referral, let's say I know someone who's selling a house in New York and looking for a house in New Jersey, but I don't have a license in New York, and I get a referral, Keller Williams in that area. How do I approach them to get commission for my referral?
What you would do is, so if they're looking to sell a house in New York to buy in New Jersey, or is it the other way around?
To sell a house in New York, buy a house in New Jersey.
So what you would do is
but
you would
they
find-
want, but
you
I
would
want
find
to
a
help them.
listing. You would find a listing agent in New York that serves the area where that house would be, and you would interview that person and see that they're solid enough that you would give this referral to, right? And then you would negotiate to say, look, I have this listing that I want to send your way, and I'm going to ask for a referral fee in order to send it your way. And we have the ability to do that through command, where you can, inside of the Keller Williams world, you can do it right through command.
Yes,
If
I've
it's a
seen that. Yeah.
different company, if there's no great KW agent in that area, but you want to refer it to a Remax agent or a Prudential agent, you can do whatever you want to.
Oh, okay.
Do it on, then there's a different referral paper form that we would send to have them, and they're going to commit to pay you that referral, which
Okay.
typically in our market for transactions, buying and selling, it's typically about 25% of the total commission. Okay. Just know that different parts of the country, Angie, depending on price point, it might be negotiated differently.
Okay. Thank you.
If you're doing business in Southern Louisiana, where the sale prices are lower, 25% of the total commission may be too big a nut for that person to give up. You might negotiate to 20% or maybe even 15% in lower price point markets.
Thank you.
You're welcome. And anytime you have a referral question like that, feel free to reach out to me or reach out to your market center. We'll walk you through it. Okay. All right. Those are your main income sources. Expense categories. We talked about the cost of sale, what you pay your broker. We have another expense category that's called the royalty, what we pay Keller Williams International, right? How much do those categories account for? Well, 30% is the commission split with an annual cap, right? We work in a capped commission world. What's the cap in your market center? Do you know? At what point of company dollar do you cap and then you get to keep 100%?
I was gonna say 36,000 once you pay your broker.
It depends where you are. In most of our, here's what you have to know about caps. It's different in each market center. And the cap is kind of set based on the economic opportunity in that market area. Where prices are higher and there's more opportunity, the caps tend to be higher. Where prices are lower, the caps tend to be lower. And so in our world in Bergen County, for 5 offices in our franchise groups, 4 of them have a $37,000 a year cap. Ridgewood, Tenafly, Fort Lee, and Woodcliff Lake all cap at $37,000. So the broker keeps 30% of the commission. When it totals $37,000, you've hit the cap. Now it switches over and the agent keeps 100% of the commission until their anniversary. If you're in Rutherford, where are my Rutherford people? Anybody in Rutherford here? The cap there is $32,000 because the price point in that market is lower. You have to do more volume to get the same commission dollars. And so just know that the caps are somewhat different. If you were in New York City, the cap would be $60,000. If you're Keller Williams in Hoboken or Jersey City, it's about $45,000 or $50,000. If you go down to Keller Williams in Shreveport, Louisiana, it's probably 22,000. The caps are different. But the commission that you pay the broker is an expense category, right? Any referral fees that you pay, somebody gives you a referral, you're paying them 25% for it, that's an expense category, right? Your operating expenses, fixed and variable, we touched on those earlier. So here's the thing, I'm going to skip over these numbers in the interest of time because we talked about those already. The idea is simply that you can run leaner in this market and you don't have to do as much gross dollar volume to net the same amount. Here's what I want to finish up with. Best practice. I'm going to come back to this slide. Number one, we said that it's really important to plan, right? To review your finances regularly. How often should you review your finances? Well, to some extent, it's going to depend on how much business you're doing. If you're doing a normal, good, healthy volume of business, I would suggest that you review your income and expenses monthly. I'm in the process of hiring a new coach for my coaching business. Even coaches have coaches. So I'm interviewing coaches right now. And one of the coaches that I really admire, who I've known for a long time, and I filled out his questionnaire. His question was, do you produce regular monthly profit and loss statements in your business? How often do you review your numbers? And you know what? I think that's an important thing that we should be doing. And if we're not doing a whole lot of business yet, then maybe we review our numbers quarterly. But I would certainly not go any further out than quarterly. Review your expenses and your income regularly, right? That's a best practice thing. And the other thing that we said is best practices to make sure that we're earning enough to not only cover our living expenses, but what are all the different buckets that we want to put money into? We did a session on goal setting weeks ago. And we said, think about all the different things that you want to fund, a wedding, a home, your kids, your retirement, all that stuff. Are we generating enough income to fill all of those buckets and building a plan to a big enough gross commission income amount to cover all of those expenses? And then are we protecting our assets? One of the things that we don't get, guys, as independent contractors is insurance. It's really a crime, in my estimation, that we can't, by law, offer health insurance. I worked for a brokerage for a period of time in the early 2000s who offered insurance to all of the real estate agents through Blue Cross Blue Shield. And the state of New Jersey said, you cannot do that because that's an employer-sponsored benefit. And if you're giving benefits like health insurance to an independent contractor, you're violating their independent contractor status and you're treating them now like an employee. Well, I don't know. I think an awful lot of agents, if it meant that they were going to get insurance, wouldn't mind being treated like an employee. But here's the thing. We don't get health insurance. We don't get life insurance. We don't get disability insurance. And so are we earning enough income to pay the premiums necessary to protect our family's assets? So that if something did happen to you, God forbid, and you got sick, have you earned enough that you can afford quality health insurance on your own? And guys, it is flippin' expensive. I know it is. And yet that just means that we're going to have to build a bigger business so that we can afford to do it. Am I covering myself, God forbid, with life insurance if something happened? Would my family be okay? And guys, there's a time in your life when you talk to financial planners, when you get to be my age, where I think for the most part, if I was to get hit by a cement mixer tonight, God forbid, I think my wife would be okay. My daughter would be okay. There's enough assets. They wouldn't lose the house. Everything would be fine. Financially, they'd be okay. They don't really need me that right now to have life insurance. The bigger threat to them is what happens if I became disabled and couldn't work anymore. Disability insurance becomes a bigger need at certain point in people's lives, even long-term care insurance. When I get to be 80 years old, if something happened and I needed to be in a nursing home or an independent living facility, guys, that's expensive. And if I don't have insurance to cover it, then it's going to eat away all of the assets that I created for my family through the years. All the money that I put aside in my estate can get whittled away if I don't have the right kinds of insurances. And when it comes to long-term care and disability insurance, you know what the best time to buy that is? When you're younger and you're healthier. because you can buy a premium policy in your 40s that's not as expensive as if you wait until your 70s. And so all of those things that we have to think about is, what do I need to do? How much income do I need to create to fund the life that I want? How much income do I need to create to buy the right types of insurances to protect those assets if something happened to me? Am I earning enough to cover all those buckets? Right? So again, a couple people I recommend you talk to. Talk to your CPA about how much money to put aside for taxes. Talk to your CPA or your attorney about incorporation. Should I or shouldn't I? What makes the most sense? What type, if I choose to? And I would talk to a good insurance person and find out, how much insurance do I really need to have to protect all of these assets that I'm working so hard to create? And am I earning enough income? Have I built a target to a big enough income to cover those premiums, some of which, especially health, can be ridiculously expensive, right? Here's best practice. Gain clarity on your big life, your hopes, your dreams, figure out what it is that you're playing for, and build a path to the right place. Set aside your personal budgets and your business budgets. Set those up. Separate your personal income from your business income. Separate those accounts. Set up your business entity if you choose to do so. Open up a bank account for taxes. Open up a different bank account for your operational expenses and other things like profit. Download the chart of accounts so that you can allocate your expenses properly. Or I am a fan of QuickBooks. I run my businesses through QuickBooks. Super easy to use. People can pay you right through QuickBooks. It works out really well. That's the accounting software. Or if you don't like QuickBooks, go find something else. But have a system. That's the point. Have a system. Hire an accountant or a CPA to handle the stuff that you don't know how to do yourself. Guys, I don't understand CPA stuff. I'm not an accountant, so I have an accountant. I'm not a lawyer, so I have an attorney. Hire somebody. Get good people to do the things that you need to have done, and make sure that you've got your good team. Set aside the dates to pay your taxes, figure out how much to put aside, and prepare for your future with insurance. Guys, those are the big takeaways from today, is where I wanted to go. My question to you at 6 minutes after the hour is, we've gone over again. I have a habit of doing that. What questions do you have about any of these things that we talked about tonight? Threw a lot at you. Any questions? You guys are like, it's 7 o'clock. I just want to have dinner and a glass of wine. Stop talking. I can see that.
With the taxes that we're paying 4 times a year, like, are you just making an estimate, or are you physically giving them money 4 times a year?
You're estimating how much you're physically giving them 4 times a year. So
Like,
for
physically
example,
writing 4 checks.
yep. So here's what happens. I have a business. I have my coaching and consulting business. My taxes are due for the first quarter today. So what I did is I went back and I looked and saw how much income did I have in the first quarter of 2021? How many business expenses did I have to offset that income? How much profit do I think that I actually have that I'm going to be taxed on? Once I know what that profit number is, then I apply how much taxes should I apply? 30%, 40%, whatever your tax person is. And to make the numbers super easy at this time of night, if I had $1,000 of taxes of profit, and I was going to allocate 40% for taxes, and I have to put $400 aside, and some of that's going to go to the state, some of that's going to go to the IRS, and I actually write a check and send it to them. And there's a voucher that you can get, these quarterly vouchers, that you can do it electronically if you want, or you can get a little payment coupon that says, this is my first quarter payment, and this is how much I think I owe, and you write that check and you send it. And then at the end of the year, on April 15th of next year, they're going to look and say, okay, Laura, this is what you estimated. This is what you sent us. This is what you really earned. This is what you really owe. You did pretty good. And you were right. And maybe you even paid us too much. You get some of that back as a refund, or maybe you didn't quite have it right. You owe us a little bit more, and they're going to ask for more, but that's how you're going to do it.
Thank you.
Guys, the other thing I'll just throw out there for you is this. Make the estimated payments, even if it's not a lot. Because here's what the IRS representatives have told me. I have some friends who work for the IRS. I know that you may question whether anybody who works for the IRS could ever have a friend, but I have some friends that work for the IRS. Here's what they tell me. If you're running a small business, what some folks do is to say, I'm not doing a lot of business. And so I'm just going to wait till the end of the year and we'll just balance the thing out at the end of the year. Well, number one, when are taxes due? They're due when they're earned. If you make the government wait longer, they're going to penalize you and make you pay a penalty for the delay. But here's the other thing. It's a flag for an audit. And trust me, you do not want to be audited. What they say is you're supposed to pay your taxes every quarter. And if you don't, if you just decide to take a shortcut and pay once a year, you're kind of running a little bit sloppy. And if you're sloppy in how you're paying your taxes, you're probably sloppy in some other things in your business again as well. So maybe we should take a closer look. Not paying your quarterly taxes when they're due can get you to be in a higher risk category for an audit. And I don't wish that on you. I have had friends, I've never been audited personally, but I have friends who have. And they just make your life crazy, right? So even if it's only $20, even if you had zero income in the quarter, well, then you don't have to make a payment if you had zero income in the quarter. But if you had something coming in, try to estimate by offsetting what your business expenses are. How much profit do you think you have left and what do you estimate you're going to put aside? Anything else for tonight, guys? All right, here's what we're going to do. We're going to wrap it up here. And this is being recorded. This will show up online. You can follow this. There's also a version of this that exists in the Ignite class. If you go online to the Bergen County Partners YouTube channel, you'll find a similar version of this topic in the Ignite Ignite videos as well. So if you missed any part of this and you're like, I wasn't sure if I understood that, go back and watch it again. This should show up online in the next day or two. Tomorrow, Patty's going to come and just go through risk management, the stay out of jail things. What are the things that you have to make sure that you do properly so that you don't run afoul of the real estate commission? And so she's going to come and do that module tomorrow night. Also will be recorded. It'll show up on the internet YouTube channel. And then the cycle is complete. We've done 24 sessions. And we'll start it up again on June 7th, rather, Monday. If you've missed any part of this, you came in part way through, we'll just start it up again and you can come circle back around with us. But tomorrow's the last one for a while. Then you're going to get your Monday and Tuesday nights free for a bit. All right. Sound good?
As always, thank you, Hal. Great information, a lot of information.